We've all seen the headlines about an impending stock market crash, and you're wondering, how do you actually prepare? I wanted to talk about 3 different ways in difficulty from hardest to easiest to implement. That way you can sleep easy at night. The first thing I want to talk about is the chart of the S&P 500. One thing you'll notice is that over time, it goes to the right and up. And this isn't by a coincidence. You have multiple factors with companies growing, innovating, improving their profits, technology, increasing productivity. You have inflation at work, making the dollar worth less. All of these things over time leads to returns in the stock market. And we're talking about the general stock market. The reason I wanted to show that chart to you was to prove that stock market is a very difficult endeavor. If you're not right and there's enough time that passes, you'll probably lose money trying to short the market. If you talk about the frequency of pullbacks, it's 5% or greater every 7 months, 10% every 2 years, and 20% every 7 years. So of course, if you can time one of these market crashes, that is where you can generate alpha in your portfolio and beat out the general market because you're making money on the way down, and then you can make money on the way back up once you buy back in or get rid of your hedge. This chart down here shows the amount of days it takes to recover to a new all-time high after a certain declining percentage. It always comes down to the market eventually recovering. So when you see people say buy the dip on social media, it's definitely valid when it comes to index funds, not necessarily individual stocks. Now that I've laid down that foundation of how difficult it is, let's talk about how you can prepare, starting with the hardest one, which is hedging. This is where you absolutely nail the top. You call a pullback and it happens. What you do here is you actually make money from the stock market going down using a few products. The first product you can use are inverse ETFs, something like SH, which is an inverse of the S&P 500. If the S&P 500 goes up 1%, this goes down 1% and vice versa. You'll see that the chart correlates very nicely with the S&P 500 chart that we looked at, except this one over time goes down. The other thing with these types of funds is they have higher expense ratios. There's more moving parts to creating a short fund versus just an index ETF that's long the market. Most of these inverse ETFs are going to be on indexes, so whether that's the NASDAQ, the Dow Jones, the S&P 500, you'll find a list of different funds that do that. You can also use these with leverage. So there's 3 times leverage, there's 2 times. I think that's about max. I think at that point, past 3 times is a little bit of a degenerate move. Plus, if you're trying to be a degenerate, you can just use the product that we're talking about next, which is long put options. You can think of put options as an insurance policy against your portfolio. And there is a time period that you have this insurance policy. So you can buy an option that lasts for a week, a month, a year. And there's a couple things to options that's a little bit more complicated. I'm not going into the details of options, but just know that there's a time value of these options and that you need to have a market down move quickly in order to make money on options because there's time decay that works against you as time passes. If you strip out the complexities related to implied volatility as well as the time value, in general, you get short delta from buying put options, more so within the money and less short delta with out of the money. If you want to understand put options completely, I have a free course on the site, mainstreetwolf.com, if you want to learn all about options. Then we arrive at the second most difficult way to prepare, and that is to allocate your portfolio differently, whether that is changing the sectors that you're invested in. So looking at something like the economic cycle, certain sectors do well in certain business cycles. So what business cycle are we heading into? Which ones are going to underperform? And basically go underweight on the underperforming sectors and go overweight on the ones that are expected to do well. Which is a little easier said than done because by the time you start to see one sector outperform and realize maybe there is a shift in the sentiment or the business cycle, then you're selling stocks that maybe will do well over the long term in order to buy stocks that have already done well. So you have to get ahead of it and you have to be shifting these companies before the upside in certain sectors happen. Outside of sector rotation, you can decide to switch to a certain company type, whether that's a slow growing company when the economy is slowing down. You can move to something like Verizon, a telecommunication company, or you can move to a utility company. These companies that aren't growing their revenue that fast, but their earnings are relatively stable. Whereas if the business cycle is shifting towards growth, growth, you want to have more fast growers in terms of revenue growth. Maybe interest rates are low, they can get cheap debt, and it's all about growth. You can also do allocation based on your age. As you get older, you take less risk by going into an investment product like bonds. Something you can use, a rule of thumb, is 100 minus your age is the stock percentage, and the rest goes into bonds. I tend to think that's a little conservative, so I use the 120 rule. And even then, I don't love bonds based on the yields that you're getting on bonds. I'm a little bit more aggressive with my stock percentage right now, but as you get older, you definitely want to shift to lower risk stocks or increase your bond position. That way, if there is a correction, you're not going into retirement and realizing you just lost half your money. Basically, as you get older, you shift from growing your wealth to conserving your wealth and making sure you don't run out of money before you die. The last way to prepare is my favorite and definitely the one that I implement the most. I think a lot of people ignore this one because it's not as sexy, but it comes down to strong personal finance habits. It really starts with budgeting and having a plan for your investing dollars on a monthly basis. If your goal is to save 20% of your monthly income and invest it, you just stick with that. Keep on investing in the stock market as money comes in, and no matter if the stock market is in a euphoric state or if we're in a midst of a bear market where everyone is very pessimistic, you keep on investing no matter what. The reason I preach this, and I believe is extremely important, is because it emotionally allows you not to freak out when there's volatility in the market. Because if the stock market did crash 40% and it's money that you need to live on, you're more likely to panic, sell it, because there's a fear of losing everything. So you sell and do irrational things at the worst possible time. But if you're investing money you don't need to live on right now, you just do nothing and you continue to buy assets that are actually at a discount that will probably perform better over a longer period of time. Also, boring like budgeting, having an emergency fund allows you not to worry if you lose your job or something comes up in life. So having something like 3 to 6 months of living expenses is kind of a buffer zone for you to find a job if for whatever reason you lose your source of income. And then if you want to be safer, you can do something like a full year of income saved up. It just depends on your risk tolerance, but having that little buffer allows you to sleep better at night. But there you have it. Next time you see some scary headline about the stock market crashing, you can kind of go back to these 3 different steps and decide, do you want to hedge? Do you want to reallocate your portfolio to be a little safer? Or just ignore it and be on your way, pretend like you never saw that headline and just keep on doing you. If you did enjoy the video, make sure to hit that like button as well as consider subscribing to Main Street Wolf, where we talk investing, anything to do with money. Thanks guys for watching and have a great day.